The forces that shape the world's financial balance are not always the countries with the largest economies. Nations such as Switzerland, Luxembourg, Singapore, and the Netherlands wield a financial influence far greater than their geographical size would suggest. People are naturally drawn to hidden mechanisms and behind-the-scenes dynamics, which is why content explaining how these countries control global money flows attracts intense interest. Beyond giants like the United States, these strategic hubs stand out as the true command centers where global capital is managed. The collapse of a currency is usually a process that begins when a government prints money without sufficient backing to finance its spending and ends with the complete loss of public trust in that currency. This is not merely an economic data shift, but a shock that destabilizes an entire country's social and political structure. In Venezuela, falling oil prices combined with poor governance triggered the crisis. In Zimbabwe, the collapse of agricultural production and uncontrolled money printing led to hyperinflation. In Iran, international sanctions cut off foreign currency inflows, rapidly devaluing the rial. In Lebanon, a paralyzed banking system and persistent political uncertainty turned the local currency into little more than a piece of paper. When a currency collapses, it ceases to function as a store of value. People rush to exchange cash for goods or foreign currency just to meet daily needs, creating a vicious cycle that accelerates the collapse even further. The loss or collapse of the US dollar's status as the world's reserve currency would not be a simple economic event. It would represent a fundamental shock to the modern financial system. With nearly 60% of global central bank reserves held in dollars and a large share of global trade conducted in this currency, such a scenario would resemble a financial doomsday. In the initial phase, import prices in the United States would surge, while global markets would be engulfed by massive uncertainty. Investors in search of safety would rapidly move toward physical assets, potentially pushing gold prices to unprecedented record levels. With its thousands of years-long history as real money, gold would once again emerge as the most reliable anchor of the system. On the other hand, Bitcoin, enabled by the digital age, would be considered a candidate to fill part of this void due to its decentralized structure and limited supply, earning it the title of digital gold. However, its high volatility may confine Bitcoin more to a wealth preservation role rather than a true medium of exchange. From a geopolitical perspective, the Chinese yuan would appear as the strongest challenger to the dollar, backed by China's massive production capacity and expanding trade networks. Yet China's strict capital controls remain the biggest obstacle preventing the yuan from fully replacing the dollar. Ultimately, a dollar collapse would not create a single winner, but rather usher in a multipolar and fragmented global financial order shared among gold, regional currencies, and crypto assets. Wealthy nations withstand economic storms by building defense mechanisms that plan not just for today, but for decades ahead. The core strategy behind this resilience is accumulating reserves for crisis periods and keeping those reserves insulated from political populism. Norway is the clearest example of this model. Instead of channeling its massive oil and gas revenues directly into the state budget, the country deposits them into a sovereign wealth fund known as the Government Pension Fund. This fund invests across thousands of companies, bonds, and real estate assets around the world, spreading risk globally. As a result, even if oil prices collapse, Norway can sustain its economy through the fund's returns and secure prosperity for future generations. Switzerland, by contrast, navigates crises through a banking system built on trust and neutrality. A strong legal framework, political stability, and strict capital adequacy rules attract global capital during periods of uncertainty. When investors worldwide seek a safe haven, this demand reinforces the Swiss franc and strengthens the country's economic resilience. In essence, successful crisis management in wealthy nations depends on disciplined saving, institutional independence, and strategic asset management deeply integrated into the global system. The global economy is built on a system in which money is created as debt and grows through interest. When central banks inject money into the economy, it enters the system as a liability that must be repaid with interest. While there may be enough money to repay the principal, the interest itself has not yet been created, forcing continuous borrowing and generating a mathematically self-perpetuating cycle. Institutions such as the IMF and the World Bank provide loans to countries in crisis, yet many nations end up borrowing again, simply to pay interest on previous debts. Governments, corporations, and individuals spending future income today have driven global debt to nearly 3 times the size of global GDP. The result is a massive debt spiral, too big to fail, kept alive by an endless flow of new credit. Amid the noise of global economic giants, new centers of power are quietly rising through strategic reforms and technological breakthroughs. Vietnam, Poland, and Estonia stand out as the most striking examples. Vietnam has positioned itself as an alternative manufacturing hub to China, combining low labor costs with high-tech investments. Its rapid growth in electronics and textile exports has made it a rising star in Southeast Asia. Poland has taken major steps toward becoming Europe's production and logistics hub. By aligning education with labor market needs, it has become a key supplier and software center for Western European companies, achieving stable growth. Estonia, meanwhile, has carried out a digital revolution that transcends physical borders. Through the e-Estonia model, the country fully digitized bureaucracy and became one of the nations with the highest number of unicorn startups per capita. These countries demonstrate that strategic planning and digital transformation, not natural resources, can quietly elevate nations up the global prosperity ladder. How do central banks create money? Out of thin air? In the modern financial system, central banks no longer rely primarily on printing physical banknotes. Instead, they create money digitally within seconds. By purchasing assets such as government bonds from commercial banks, central banks credit these banks' accounts with newly created digital balances. This process, known as quantitative easing, QE, allows billions of units of fresh money to be injected into the system with a single keystroke. If the money supply grows faster than the production of goods and services, purchasing power declines and inflation emerges. Central banks attempt to manage this balance through interest rates, raising rates to make money more expensive, reduce spending, and withdraw liquidity from the system. In essence, money is digitally created as debt and controlled through the weapon of interest rates. For thousands of years, gold has retained its value and has been the first refuge for investors when financial systems shake. Its core strength lies in the fact that no government can print it endlessly, and that it possesses intrinsic value. During economic crises or wars, confidence in fiat currencies erodes while demand for gold surges. For example, during the 2008 global financial crisis or the geopolitical tensions of 2022, stock markets fell as gold prices reached record highs. Gold also acts as a shield against inflation. As purchasing power declines, gold often rises in parallel, preserving wealth. However, it is important to remember that gold is not a return-generating asset, but an insurance tool. It does not pay interest or dividends. It merely preserves value. For this reason, during periods of stability and rising interest rates, gold can lose its appeal. Ultimately, gold is considered a safe haven not because it makes people rich, but because it is often the last asset standing in times of crisis.